Joining me now on a Fox Business exclusive is Raymond James CEO Paul Shoukry, who has a very big business in wealth management. Paul, I know you deal with the sophisticated investors, but when they see big moves like this and request that you play the meme stock game with their portfolio money, how do you handle that?
Well, first, Liz, it's great to be here, calling in from the Summer Development Conference, our annual advisor conference, where we have over 1,000 advisors, families, wives and children and husbands here in Orlando, Florida, totally unique to Raymond James and really a testament of our family-friendly culture. As far as meme stocks go, we are a long-term financial planning-oriented firm. So I've spoken to hundreds of advisors over the last 2 or 3 days here, and meme stocks hasn't come up once. Clients are focused on the long term, managing their portfolios, reaching their goals, thinking about estate planning, and meme stocks really doesn't fit into that long-term conversation.
What are they hearing from their clients? When you speak to your financial advisors and you say, what do they want? What are they worried about? What are they telling you?
Yeah, client sentiment is up quite a bit. Quarter over quarter, it's up from 52% in our internal surveys last quarter, this time last quarter after Liberation Day, to 68% now. So what financial advisors are telling us is their clients are more confident about the markets and the economy overall. There's more certainty, less shock from the Liberation Day tariff announcements. And really what the advisors are wanting from their advisors is just more sophisticated financial planning, managing both sides of the balance sheet, liability management, insurance management, estate planning, and all the things that we as Raymond James help offer advisors the products, tools, technology, and services to help advisors provide that level of sophisticated advice to their clients.
I feel like I'm hearing from you that the customer base seems pretty optimistic, or at least, as you said, they feel that there is a decent market atmosphere at the moment. Therefore, when you hear, say, for example, we just talked about Chipotle Mexican Grill. Chipotle said a concerned consumer hurt their earnings. So we're not really seeing that, especially when we look at retail sales and we look at how the economy is doing. In fact, that's the reason it looks like the Federal Reserve has zero chance of cutting interest rates next week during their meeting. Fed funds futures are showing something like a 2% chance that we would see a cut when they announce it on Wednesday. It's a little bit different for September. It jumps up to 62%. But tell me what you think is really going on out there when a company like Chipotle or, let's say, General Motors says, you know what, things are going to get worse from the tariffs, even though we're starting to see deals strike. Yet the sentiment doesn't match that out there.
Yeah, you have to look really at each individual company in terms of the impact that they have from tariffs and also the impact that their consumers have from tariffs. And so it's very unique and individualized, which is why we focus, we're focusing on higher net worth clients on average. And what our financial advisors help them do is understand that complex landscape and keep a diversified portfolio of companies that can generate good returns over a period of time independent of that environment.
Your earnings, which you announced, your adjusted EPS, you missed on that, but your revenue came in around $3.4 billion. That was actually a 5% gain year over year. What jumped out at us, Paul, was that your private client group unit, it's not the biggest part of your business, certainly, but assets under administration rose 11% to roughly $1.57 trillion. Is that a function of just the market doing so well, or is this an opportunity for you to grow that business even more, since it shows that that's the real growth area?
Yeah, we're really pleased with the results that we produced this quarter. Client assets, as you said, up 11%, fee-based assets up 15% year over year, and 8% just over the past quarter. So it's helped by the market, of course, but really driven by all the great work that our financial advisors do with their clients. The net new asset profile at Raymond James is good, and it's growing in terms of our recruiting pipeline for new advisors that really want to come to Raymond James for our best of both worlds value proposition, where we offer those advisors the scope and scale of capabilities, technologies, and products of the biggest firms, but a culture of a family-friendly firm, as you evidence here at Summer Development Conference. So We've had leading kind of net new asset growth in the industry. Our pipelines are continuing to grow, and just offering the advisors capabilities so they can continue to provide sophisticated advice to their clients.
Paul, you're a litmus test for what's going on out there when it comes to sentiment of high net worth clients. We appreciate you coming on to open your books and talk about it. Thank you.